So let's kick it off with the most widely held stock in the United States. That's Apple. After losing a series of challenges, Apple is officially halting online sales of its Apple Watch Series 9 and Ultra 2 over a heart rate patent dispute. The news, it hasn't really hurt the stock, which is up nearly 50% this year. Give us a sense, as an investor, how big of a deal is this for Apple?
I don't think it's that big of a deal, Frank. I mean, I think they have other problems, but this will get resolved. Most people who buy the watch don't even know that that function's available. I've heard many people say, well, this was a stunt to get to pull forward sales. It may have been. I don't think it is. I bought one, though, in anticipation of, them stopping the sale of the company, of the watch. But the important thing to note about Apple is they have announced $100 billion in share buybacks. That will put, whether or not the stock rallies much from here, that will put a floor under the price while they figure things out. And this notion about innovation, that they haven't innovated, that was the concern when Tim Cook took over in 2011. Stock's up 1,600% since then. So you kind of need to respect the name and use weakness to add to holdings.
Yeah. As you mentioned, big rise under Cook, up 1,300% under Cook. By the way, Nancy, I don't think you can call it a stunt if you actually bought one. I think it was just an effective sales technique if you actually bought one over the concerns, but we're going to move on. We're going to turn to media and ongoing reports of a possible Paramount Warner Brothers Discovery tie-up to create a streaming giant potentially capable of challenging a Disney and a Netflix. Investors appear just a bit unenthusiastic about the prospects of this deal. Shares of both companies actually down sharply this week. What's your take?
I mean, I think the biggest concern about this deal is the debt load. So they're going to, if they combine, they'll have over $60 billion in debt. Paramount has negative free cash flow. They are committed, or at least the Warner Brothers CEO Zaslav has said he's committed to linear TV, which is in decline. So I just kind of harken back to Office Max and Office Depot, a model that was going away, and they were trying to combine to at least mitigate some of the damage and the loss in sales and free cash flow. But this is a business model that I think you want to run away from. Streaming is here to stay. They have some streaming exposure. I'm a Paramount Plus subscriber, but I just think there's better places to be invested, particularly with the debt load and the space that they're traveling in.
Yeah, right now we're showing some of the assets that would be combined if this deal possibly happens. So some pretty, big name things: MTV, DC Comics, a lot of big, well-known things. I do want to ask you, maybe you're not that enthusiastic like other investors about this tie-up, but what does it mean for our parent company Comcast and its streaming ambitions?
I mean, Comcast has been a sleeper surprise this year. They've done, the stock has done really well in an environment I wouldn't have expected it to. I think Comcast has a secure spot because, they have CNBC. Among other assets. But yeah, the space is getting crowded. And, I think the way I see it, it reminds me of when the telephone company split up and then remerged. It's a space that is slowing, and so you have to stand out. And the parks that Comcast owns, there's many things that add to the bottom line and the attractiveness of the name that Paramount and Warner Brothers don't have. And remember, they have a huge dependence on box office, and we see that in a slow decline rather than the pre-COVID bounce we got.
Appreciate the CNBC shout up. Comcast shares up just about 26% year to date. So, as you said, good year. All right, last but certainly not least, Alphabet this week agreeing to a $700 million settlement over anti-competitive behavior in its Google Play Store. So this is just the latest in a string of antitrust actions against big tech here in the U.S. as well as overseas. What do you think?
Well, call me an unenthusiastic owner of Google. We do own it. We do think that it's attractively valued at 17 times earnings, but and they have a wide and deep moat around them, which is an important thing to be aware of. They're behind on generative AI. The word is that this is going to be a better solution than Microsoft's, but they lost the intellectual ownership of it. So the suits are not super debilitating to the company. You had $700 million that they have to pay out in the state suit, and then the Epic suit, we'll see that has yet to be decided. they're going to appeal all of this. So these things are going to string out into 2024, 2025. So I think you use weakness to add to the name if you don't own it. But it's not a major holding for us. It is a holding.